vibration that lets success soar high. I will achieve, I will fly high. I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the major developments in the banking sector. I am Ruchika Chitravanshi and today is July 27, 2023. In today's episode, our cover story will focus on the reforms needed in the multilateral development banks such as the IMF and the World Bank. For Bankers View this week, we have with us Sanjay Kedia, President and India CEO of Marsh Insurance Brokers. In Banking for You, we will tell you all about frictionless credit. Our consulting editor, Tamal Bandhopadhyay, will join us to discuss the issue around bank CEOs' tenure. At the end of the show, we will tell you the results of last week's poll and the question for this week. Given the present global challenges, there is a strong case for strengthening multilateral development banks such as the IMF or the World Bank. The current Indian G20 presidency is pushing this issue with all the other member countries and institutions. So what are the proposals on the table and what will it take to reform these institutions? Here's my report on the issue. The world has over 600 million people still living in extreme poverty. At the same time, sustainable development goals are badly off track and climate challenges are growing. In this situation, reforming the multilateral development banks or the MDBs, such as the World Bank or the IMF, has become essential. The G20, currently presided over by India, constituted an independent expert group to strengthen these institutions and prepare them for the challenges. It is led by N.K. Singh, the chairman of the 15th Finance Commission, and former US Treasury Secretary Larry Summers. Its report was part of the discussions of the third Finance Track meeting held in Gandhinagar recently. The report has identified the need for a significant increase in new equity for MDBs. How much? $100 billion across all MDB institutions. The report has also said that an incremental $500 billion per year by 2030 is needed in official development finance, of which $260 billion should be channeled through MDBs. The report focuses on the triple agenda of trebling financing by 2030, including setting up a triple funding mechanism through a fund. Why are these reforms crucial?
One of the problems with the MDBs is they have to work with countries, and that means that they have to get country agreement on what are the reforms that they are proposing, and they should persuade the countries that what they want done is sensible, even in the country's own interests. They may not be able to get 100% success, but if they get a reasonable amount of success and they're able to say that, look, this country is on the right track as far as managing climate change and so on is concerned, we want to do some lending. Now, in the past, the lending was largely to the government. Now they're talking about leveraging private investment. That is a new thing. And they have to come up with specific proposals. How are they going to help private investment? Who's going to choose which private investment you're going to help? Because, if it's MDB lending, the government of India has to approve each lending. But if you're lending to the private sector, is the government of India then in a position of approving a lending to a particular private sector rather than another? This becomes an issue, where differences can arise. So you need more detail on how is the World Bank going to manage this.
By 2030, an additional spending of $3 trillion will be required to meet the Sustainable Development Goals. This means a 75% increase in health and education. $1.8 trillion is required for climate action, which would largely flow towards creating sustainable infrastructure. The expert group has also come up with a global challenges funding mechanism of $50 billion. This is to tap into a coalition of willing donors and non-sovereign investors. These banks also need to change their approach to partnering with the private sector. The report has suggested organizations such as the IMF and the World Bank should help governments reduce policy and regulatory risk and align financial product offerings to private capital market gaps. This expert group's recommendations were not part of the final chair summary issued at the end of the finance ministers and central bank governors meeting. What is the way forward for the implementation of these reforms?
I don't put much weight on the fact that the chair summary didn't say anything more than taken note of. I mean, for the simple two reasons for that. One is this is only part one of the report, and the report says there's a second part which really talks about how MDBs should engage the private sector, which many of the G7 members are really very concerned about and interested in. So they would want to see those recommendations before they agree to taking any step. What the MDBs have to do is to increase their assistance by about 200 billion, which would be 3 times what it is now. What the report says is that using the existing balance sheet more efficiently, the MDBs can expand lending a little. But to achieve what we want, there will have to be a general capital increase. That is a political decision. But let's say by the end of the year, if a kind of broad endorsement is given that yes, technically the focus is really on the multilateral development banks, the World Bank, the ADB, various others. If there's a general endorsement that yes, you should increase the lending as quickly as possible using your existing balance sheet, and we will meanwhile process or you bring proposals for a general capital increase, which obviously will take time, maybe a couple of years. But if the signal is that that's what we want to do, this could happen.
According to the report, even if implemented with maximum effectiveness, these measures will fall substantively short of what is needed. Therefore, the report says general capital increase should occur concurrently with implementing the G20 capital adequacy framework that could generate headroom to lend $80 billion more each year. There's a lot that needs to be done, but the main issue is the inescapable need for a significant increase in new equity across all the multilateral development banks. All eyes will now be on the G20 Leaders Summit to see if countries get on board with these suggestions. Moving on, in our Bankers View today, we have Sanjay Kedia, CEO and Country Head of Marsh India Insurance Brokers. Mr. Kedia spoke to Business Standard's Manojit Saha on the impact of COVID-19 on employee benefit insurance and also digital health products.
Hello and welcome to the Business Standard Banking Show. The insurance regulator has brought several changes in the last 1 year, primarily aimed at increasing the insurance penetration. These changes have many implications for the players. To discuss some of these implications, today we have with us Sanjay Kedia, Country Head and CEO of Marsh India Insurance Brokers. Mr. Kedia, welcome to the show.
Thank you.
So let me start with asking you, how has been the performance of Marsh India in FY23 in terms of the top line growth, and what would be the key drivers?
So Marsh India has seen consistent growth year after year. We crossed 8,000 corporate clients in India, and the total amount of premium placed for the financial year ending March 23 was 15,000 crore, which was a growth of around 25% compared to the previous year. And we expect similar growth of 20 to 25% in the next year as well.
That is this year?
Yes, absolutely, this year. And in terms of drivers, I would say the biggest driver is the group medical business, which the corporates buy for their employees. That has seen the biggest growth. And the underlying health inflation, the need for post-COVID people being more conscious, people buying higher limits. So all these factors have been driving.
The other area I wanted to know is cyber insurance policies. Globally, it is gaining popularity. In India also over the past few years, so the big banks have taken cyber cover in India. But do you think the coverage is adequate in proportion to their business?
That is a challenge, I would say, is a global phenomenon. It could be more pronounced in India, but it is a global phenomenon. So cyber insurance, as you know, is relatively a new coverage which we saw emerging in the last 5 years, more so. And we have seen, say, in the banking sector, say on the public sector side, we used to see people buying around 10 crore limits, 25 crore limits, 50 crore limits gradually. Now it has gone up to, for the largest bank, it would be touching almost like over 800 crore, and some of the other banks also around 500 crore. So the limits have gone up compared to what they were buying before.
500 crore and 800 crore.
Yes, for some of the largest public sector banks also, these kinds of limits are there now. And some of the largest private sector banks also, now they're buying around upwards of 500 crore. So those kinds of limits have arrived in the market. But to answer your question, are they adequate? I would say there's never enough in a area which is world filled with so much of cyber uncertainty.
Right.
So given the size of the balance sheet and the size of the business, these limits would be still inadequate, but they are significantly more than what they used to be.
Right, right.
But in terms of the reinsurance market, the capacity has shrunk last year.
Okay.
So the worldwide capacity has shrunk and the rates have risen. So the cyber insurance market has become more expensive and the capacities have become less. Clients want more capacity, both in India and globally. So this is a very interesting piece of the market where there's more demand and less supply.
The digital banking has also gone up substantially over the last few years. From that point of view, also the coverage may not be adequate, isn't it?
That is very true. Given the total exposure and the business at risk, the covers are highly inadequate, but they are significantly more from the past, but they are inadequate from the size of the exposure.
Now, coming to some of the regulatory aspects, now IRDA has given flexibility to insurance companies for paying commission to the brokers. Has that resulted in insurance companies paying higher commission?
In the corporate space business where Marsh operates, we have not seen change from what we used to see prior to this freedom. So I would say the corporate side of the business, both on the premiums and on the commissions, were highly competitive, and we have not seen a change. But I would like to believe that this is a very welcome change because Indian market is now in line with international best practices, because both the premium rates and the commissions are left to market forces. So market forces drives efficiency and thereby a better result for all parties, including customers.
Staying on this regulation aspect, IRDA has also taken several steps to enhance distribution with initiatives like Bima Sugam and Bima Vahak. How does that impact the insurance brokers business?
I would say all the initiatives which IRDA is taking for the increase of insurance penetration are extremely welcome by all the players of the market, be the insurers, be the brokers or the agents. Because fundamentally, the insurance penetration has been an issue in the Indian market for decades. And the concerted effort IRDA is taking on several initiatives. These are one areas which you shared, but IRDA is also unleashing several reforms, ease of doing business, regulations focused on materiality of the aspect rather than on small issues. So most of the regulations are being rewritten to allow a business friendly environment and focusing on the big risk issues. So I think we have never seen a more progressive insurer who's driving change across all aspects of insurance market functioning. And we are all extremely excited and positive on these changes.
And finally, if I can ask you, the hardening of reinsurance rates, what is your take on that?
I think this is an area of concern and it's a global concern. And I would say across all lines of business, there has been a hardening of rate. It seems we are in a more risky world, not only geopolitical risks, but whether it's hurricanes, whether it's other natural catastrophes, the wildfire.
Right.
The world has been seeing many of the events which were supposed to be 1 in 100 years to be happening almost every year. So with so many natural catastrophes and other risks the world has seen, the insurance market rates have gone up more so in the last 3-4 years, and it seems they are here to stay.
Right, right. The spike in reinsurance rates are here to stay. Well, thank you, Mr. Kedia, for speaking to Business Standard. It was a pleasure talking to you.
Thank you, Manoj.
Sanjay Kedia makes an interesting point about how corporates have become far more aware, conscious, and committed to the cause of protecting employee health and wellness. With a focus on rural finance and the need for its digitization, the Reserve Bank of India announced a pilot project in September 2022 for end-to-end digitization of the Kisan credit card lending for the farmers. The project, labelled as Frictionless Credit System, is designed to smoothen the KCC by automating various processes within the banks and integrating their systems with service providers. In Banking for You today, let us look at what frictionless credit is and its significance, especially for rural finance.
Frictionless credit is a borrowing approach that aims to streamline and simplify the lending process for consumers. Unlike the traditional credit systems where individuals need to go through extensive paperwork, credit checks, and lengthy approval procedures, frictionless credit promises a smoother and faster experience. The Frictionless Credit Pilot Project is set to transform rural finance by digitizing Kisan credit card lending, ensuring a seamless and efficient credit flow to the unserved and underserved rural population. The Kisan Credit Card Scheme was launched in 1998 to issue cards to farmers based on their land holdings for uniform adoption by the banks. It was introduced to provide short-term credit and term loans to the farmer who can readily purchase different agriculture inputs such as seeds, fertilizers, pesticides, and draw cash for immediate production needs. Over time, the scheme underwent many changes. In 2012, it was revised with an aim to simplify the borrowing process and facilitate the issuance of electronic Kisan credit cards. With a simple documentation and credit delivery process, the scheme became attractive for farmers who were generally not aware of banking procedures. However, the RBI's Frictionless Credit Pilot Project aims to eliminate paperwork entirely and create a digital record of lands and other assets to facilitate lending to the farmers. At the G20 Finance Ministers Meet, which concluded a few days ago, the RBI exhibited the upcoming digital tech platform, which is being developed to enable frictionless credit to various types of loans, including MSME and personal loans, by making use of various digital data points. This platform would facilitate account openings through eKYC, access to digitized state government land records, credit bureau scores, and more. The document creation and loan disbursement would also be fully automated. For the digital dairy loan leverage, the records available with milk cooperatives about the digitized milk pouring would be used to disburse credits in an end-to-end digitized manner. The RBI's Frictionless Credit Project is currently implemented in select districts of Tamil Nadu, Madhya Pradesh, Karnataka, Uttar Pradesh, and Maharashtra. The pilot on digital dairy is being carried out in Gujarat. They have been operationalized in association with several banks and RBI Innovation Hub, with the potential to include those who may have been excluded from the traditional credit system due to a lack of credit history or limited financial data. The frictionless credit system has the potential to reshape rural finance and make it more inclusive. However, striking a balance between innovation and consumer protection will be vital to its long-term success.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The project was developed by the central bank and its subsidiary Reserve Bank Innovation Hub. During the third G20 Finance Ministers and Central Bank Governors meeting held on 17th and 18th of July in Gandhinagar, the RBI unveiled its Innovation Pavilion to showcase recent innovations in frictionless credit. In our next segment, I spoke with our consulting editor Tamal Bandyopadhyay on issues around the tenure of bank CEOs and all the trends in the financial results of the banks. Here's the chat. Hi, Tamal. Welcome to the Business Standard Banking Show. This week in your column, you've touched on a rather sensitive subject, and you've talked about the trends in the tenure of the private sector bank CEOs. So what are some of your observations, and what do you think of the current trends in the tenures of these CEOs?
India is a very few market actually where the CEO tenure is capped. The other three, among the G20 nations, there is no other nation. There are three other countries I am aware of it: Ghana, Myanmar, and Nigeria, where the CEO tenure is capped. If you look at the US, there are CEOs who have been there for decades and decades, 4 decades, 3 decades. There are many examples. So that's a presenting mere facts. Other part is this, what happens is this, you don't get at one shot, right? Reserve Bank of India, what the RBI norm says about private sector bank CEOs, that you can have 15 years and retirement age is 70. So if you are a young CEO, and I've given one example, who will be completing 15 years in his 50s. So then what is going to happen? RBI says that if you complete 15 years and you're still not 70 and you are eligible for a reappointment, then you have to stay away from the bank in whichever way, completely have nothing to do for at least 3 years, and then you can be reconsidered. So RBI norm, what is currently is in place, is if you are a promoter, then you cannot have more than 12 years. If you are a professional CEO, you cannot have more than 15 years. And the other side is this 70 year is the retirement age.
There are differences in private sector and public sector banks also when it comes to these practices. Can you take us through what are the differences and how do you compare them?
In private sector, 70 year is the retirement age, 15 year for professionals, and 12 years for promoters. That's it. And as I said, if you are young enough to continue, then you have to wait for 3 years, a full separation from the entity. You can continue again after 15 years, after 18 years. But in public sector, it's a very different ballgame. Till recently, it was typically 3 years, 2 years, even less than 2 years. And retirement age was 60. Now, what happened is this last year, Finance Ministry, and remember, the public sector appointments are done by government on the recommendations of the new avatar of Banks Board Bureau. That one, the government has the power of appointment and the government has the power of sacking. RBI has nothing to do as far as public sector bank CEOs. Now, what are the current norms of the public sector bank CEOs? Your tenure become 5 years, and it can be another 5 years. But can you cross 60 years? No, that's not the case. And again, among the government-owned banks, State Bank of India has different norms. In case of State Bank of India, in case of State Bank is the chairman, unlike the other nationalized banks, which is MD. In case of State Bank of India, one can be a chairman before 60, and it's a 3-year tenure. So if you are approaching 60 and become the chairman, almost when you are 63, you can be there. And in the history of State Bank of India, we have only one instance, Arundhati Bhattacharya, she got 1 year extension, otherwise no extension.
What is the policy for appointments?
Well, appointments, as I said, for the public sector banks, appointments are done by the government. Reserve Bank of India has nothing to do. And of course, earlier it was directly by the government, but then the BBB, Bank Board Bureau came. It has been renamed now. So that's the recommendation authority, and the government does the rest of it. As far as public sector banks are concerned, typically board recommends the persons, and there is never a one name sent to the RBI. Typically, it's 3 names Reserve Bank of India are given. And if you see, again, going by the tradition, RBI does not get into the value judgment whether number 1 is better than number 2 or number 2 is better than number 1 or where does number 3 stand, nothing like that. RBI, I think, approach is get into the fit and proper criterion. if the person is fit and proper, so it's essentially a tick mark kind of thing. Number one gets the RBI nod. Unless and until the person is fit and proper, number two is not looked into, or number three is not. But other exceptions, yes. Very recently, I mean, a little over a year back, RBL was one case, was an exception, where the number one recommended person did not get the nod of Reserve Bank of India, number two got it. And that was not not on the basis on fit and proper criteria, because number one person who was recommended by the board was indeed a fit and proper person. But RBI felt that person probably would not be able to handle the bank. At that point of time, RBL, the state of affairs, was a little sensitive. So RBI chose number two. But let me repeat, that's an exception.
One last thing, Tamal, that we have to touch upon is the bank earnings, and the results have started coming in. There have also been some concerns, some reports about concerns around new NPAs. What do you think of the trends in the bank earnings, and are there any areas of concern?
So as of now, as we speak, things are pretty good. The banking sector is continuing with the good period or golden period, whatever you said. I think they never had so good in the past 1 decade at least. But there are challenges ahead. Namely two challenges. One is the credit cost, particularly in the retail segment, and second is the cost of deposits. So they will not be able to they will not be able to jack up their interest rates anymore, the lending rates, because we have reached a peak as far as lending rates are concerned, policy rate is concerned. But they will have to keep on maintaining the high deposit rates, or if not, make it even higher for the next 6 to 9 months to attract deposit to support their credit.
All right. Well, Tamal, that's a very balanced view that you've given of the bank earnings, that the growth trend continues, but as you said, challenges persist, and great food for thought on the issue of tenure as well. And thanks for putting in context the tenure and the consolidation of banks, and the fact that we have completely different rules for nationalized banks, for private banks, and the SBI. Of course, I'm sure that there are the right people who are listening, and maybe we might see some action on this front in the future. Thank you so much, Tamal, for joining us today, and we'll see you next week.
Tamal makes some interesting observations about the tenures of bank CEOs and how these practices differ from private to public banks. It's time now for the results of last week's poll. Here's what we asked you last week. Will you try the e-rupee? 74% of our respondents said yes, and 26% said no, they are not interested in the e-rupee. In its June 8th policy review meeting, the Reserve Bank of India left its key interest rate unchanged for a second straight policy meeting, but signaled that it wants to see inflation moderate more while keeping an eye on the monsoon. What will this mean for interest rates? So here's our question for this week's poll. Will the RBI keep the interest rate unchanged in the next monetary policy? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.